Hello, everybody, and welcome back to the M3 market update. Before we get started, I just want to use this opportunity to send out my condolences to those who have lost friends, family, homes in Lahana. Devastating wildfire there. Seeing some of that video footage is really heartbreaking. So just want to send out my prayers and best wishes, and just know that everyone is in my thoughts, and truly heartbreaking what's happening there. So guys, welcome back. There's a lot of conflicting information out there right now, which is kind of, I think that's the nature of 2023. But it's getting to the point where you have on the one hand, news articles about home prices being higher than ever, or starting to tick back up again in some places. And then on the other hand, you have downgrades of Fannie, Freddie, and some small banks. Some people talking about this as politically motivated. To me, all signals are important. All signals need to be looked at. And so just as we have home prices going up, we can't ignore what's going on with these downgrades either. And I think they point to, what I'm seeing will likely be a fight in 2024, or as we run up to the election, over our debt. But important because I think, in probably a year, we're going to look back and understand that much of the activity of what happened here wasn't about the reality of what was going on, but it was about how loud the narratives are. And so, we need to be paying attention to those narratives and try our best, our very best. And there's no way we can do this because we're coming from our own perspective, but try to be objective when we look at those narratives. So an important thing that I did talk about again in this week's Substack, so I did two. One was just kind of the long post, and another were the stats. But I talked about the fact that, we saw that delinquency tick up in the FHA, VA borrowers, as well as I'm starting to see those that you can tell were investments, properties in the Fannie Freddie, those are starting to come under stress. And so in many ways playing out, if you have a realistic or, understanding of what happened last time, we're kind of following the same playbook. Now everybody can sit here and say it's not going to be like 2008. I'm not here to say it isn't or it isn't, but I think that people need to understand what actually happened back then. And it wasn't just subprime. In fact, the foreclosure crisis really, that those investor loans were a small component of what happened when you saw delinquencies spike and top out in 2010. And so in the Substack, I kind of list out the delinquency from, going back to probably Q4 of 2006. I would encourage everybody, when you hear headlines like delinquency is lowest on record, etc., question that, because there's ways people can say that without it actually being really true. And so I put the Fed numbers in my Substack. I would encourage you to stay focused on those versus others from Black Knight, because they're not giving a representative sample. Black Knight today has 80% of all mortgage loans on its platform. But that wasn't the case back in 2000. So looking at their information is going to be, it's just not apples to apples. And they don't do a super good job of disclosing that. So again, big themes that I talk about here: question the data, understand where it comes from, then you'll understand its limitations. And I think more and more, what I've come to realize is we have to triangulate the data. We have to come at it from multiple sources to really understand, because there's just so many biases, some of them not intended, but data is not equal, and you always need to understand its limitations. Okay, it's been a crazy few weeks. I'm a little tired myself, so this might be a little shorter today. Apologies, although I'm sure you don't want to listen to me talk that much. But we'll go ahead and get started. A lot in the Substacks. Really encourage you guys to read those. Talk a lot about, another important subject, which is fraud. a Philly Fed paper that got circulated on social media last week that basically posits that 30% of all investor loans in mortgage are actually fraud. That's huge numbers coming from the Philly Fed, by the way. So I've said this on social media, and I truly do believe this that we are going to see more fraud this cycle than we did last time, mainly because we just piled so much into such a short period of time. I really, for those of you that weren't in the industry, I can't explain what 20 to 22 were like. It was, you never slept. It was pure insanity, and you didn't really have the labor or the technology to keep up with it. So, okay, without further ado, I'll kind of go through these stats this week. I added a whole bunch of short-term rental stats that we'll go over, so looking forward to that. But top cities with largest percent increase week over week for the week of July 30th to August 6th. So again, San Ramon showing up here again. When I look at San Ramon on Realtor, I see a lot of new build sites. So if anybody has any intel, please let me know. Someone also told me about a company closure there, but this is kind of nuts how much they're showing up. So San Ramon up 16.52%, up from number 2 last week. Rosemary Beach up at 12.5%. Nashville up at 9.96%, and this is up from number 8 last week. And I've said here, and I'll say it again, Nashville is going to be important to watch. I honestly believe they're going to tell us directionally where things are going. And some big moves here in Nashville. We saw this with Las Vegas back in May with big ticks up. They kind of like normalized, but never normalized back to that very lower number. So there can be outliers, there can be data issues, so we're going to keep our eye on this, but Nashville is starting to pop up in several places. So I believe this is a city on the move. And just FYI, that's something I'm going to try to do over the next couple weeks is really, instead of giving you all this disparate data, and I know it's hard to get a cohesive picture, I'm going to do a section on like my top movers, meaning that they're showing me movement in listings for sale, listings for rent, listings for Airbnb, average daily, rental rate movement. So hopefully to give you a better picture. But as always, you can reach out to me on LinkedIn or leave a comment here, and I can get you a more comprehensive schedule of some of these metrics. Okay, so then Portsmouth up at 7.8%, and then Costa Mesa up at 6.35%. Now I have a follower who I believe lives in Costa Mesa and sort of asked me about these stats, and I said, it is a smaller number of listings, but compared to their average, there's also moves there. So hopefully this follower will give me some intelligence about if they can validate what I'm actually seeing in the numbers. Okay, so then we have the top cities with largest percent increase in inventory compared to an 8-week average. And I'm excited we can do these averages now. A lot of people will tell you, why are you looking week over week? The data's too noisy. Well, I think waiting month over month is too late. And so as much as we might have to deal with noisy data, I do think that it can give us early indications. And now that we have these averages, it'll be even more meaningful. So top cities with largest percent increase in inventory compared to 8-week average. San Ramon up from number 3 last week at 26.5%. Rosemary Beach up at 15.24%. Encinitas up 14.45%. This was actually down from number 2 last week. And then Nashville up at 4.3% compared to its average. So this is a move. Bozeman up at 7.32%. Okay, top cities with largest increase in inventory from start. This is from January. And so we had a movement here. We kicked out Seattle at number 10. Nashville took its place. So I'll run through these really quickly because the top 10, we've seen movement for a long time. The top 10 stayed exactly the same, but we've started to see movement recent weeks, which tells me that other markets are starting to have are starting to be interesting. Okay, so San Ramon up 138%, Coeur d'Alene 88% increase in inventory from start. Denver 59.3%, Austin 54.52%, up from number 5 last week. So that was at number 4. San Francisco 53.79, down from number 3. San Francisco moving down is very interesting to me. So, it's been at the top there since January, but watching it move through these rankings, has it kind of bottomed? We'll see. I mean, we're certainly not hearing good news about San Francisco, but, this will be interesting to watch. San Jose, 48%. Portland, 46.11%. Galveston, up from number 9 at 41.29%. Carlsbad at 36.9%, down from number 8. And then 10, Nashville at 36.64%, kicking Seattle out of the top 10. Okay, so this week I did do the rent prices from real pages and occupancy. Now, very interestingly, they recently started adding some metrics on every city page where they would quote what the occupancy was year over year. And I can tell you that occupancy is down in most of the cities I track. So, but what's also interesting, Real Pages, which is under investigation by the DOJ for what someone ultimately call like price fixing, interesting that there are certain cities that for those synopses, they don't actually list the occupancy metric. So you'll see that occupancy is down in a lot of the cities. And then for the ones where they don't list it on that main page, I find it interesting. That's Chicago, Dallas, Houston, Nashville, Phoenix. Cities like this, they'll talk about it, but they don't put the actual number where on many of the other cities they do. So there's some managing of the message, I would say. And again, so I'm just repeating myself, but we have to question the data. And someone else gave me another source where I can, that I'll be able to get free sort of rent price movements. I'll be looking at that next week as well. Okay, so top cities with the highest percent decrease in average rent, June to July. So Nashville up at number 1, 15.92%. Highest percent decrease. Okay, Asheville, down 13.71%. Coeur d'Alene down 11.8%. Destin down 10.2%. Chicago down 9.68%. Pretty big moves there. And Nashville and Chicago, both cities in the top 5 here in terms of average percent decrease in rent, but also cities that Real Pages didn't think that they need to put the actual number of the decrease in occupancy. Okay, top cities with largest decrease in occupancy year over year. So these are the cities where they did list it. So Augusta was down 3%, Tucson down 2.4%, Boise down 2.3%, Atlanta down 2.3%, and Indianapolis down 2.18%. A notable mention here is Miami down at 1.9%. So Miami, interesting story in terms of narrative. Everyone's sort of talking about the new tech capital down here. Ken Griffin with Citadel moved down here, but they've had negative demographic shifts since 2020. And so I think the story might be more interesting or probably not what people have touted it as, and it's very bubblicious, very bubble in the sun. I mentioned that book in my Substack. Great book. You should check it out. Okay, so top cities with highest percent increase of single family rental listings from July 30th to August 6th. El Cajon at 26.35% increase, Encinitas 25%, Johnson City, this is interesting to see this, 20.3%, Coeur d'Alene 17%, and Augusta at 14%. So we're seeing a lot of repeats of cities here. And so that's why I think it'll be interesting when I am able to kind of start that section of cities on the move. Okay, top cities with highest percent increase of single family rental listings to average. And so again, hopefully this will give us a better view, but Augusta up at 22%, Oceanside 15%, Coeur d'Alene 14.57%, Cape May 14.29%, and El Cajon at 13.3%. Honorable mention here, Nashville again, 11.62% increase single family rental listings to average, number 6 there. Okay, now top cities with the highest percent decrease of single family rental listings. Again, this is, could be for movement because they went to listings for sale, could be they went to short-term rental. These are the types of things we're going to try and understand. But essentially, Cape May down at 33.3%. Rosemary Beach down 33.3%, Austin down 30.9%. And now seeing Austin with a decrease like this in single family rental is really interesting. So that one we're going to keep watching. Costa Mesa down negative 12.5%, Brattleboro down 11.54%. Okay, so now Airbnb. Now that I have access to historical data for all the cities that I track, it'll take me a few weeks to get some good analysis around here, but I'm starting to have some time to look deeper into some of these trends. But on average, short-term rental listings in the cities I tracked increased 1.28% from June to July and about 6% since January. Now, this is interesting to look at last year because they increased from essentially January to July of last year of 2022 was 23%. Okay, so although you still have some FOMOers and you still have people piling in to kind of the passive income, short-term rental, Airbnb craze, it's slowing down significantly from where it was last year. So, and I believe by the end of the year, we'll start to see actual decreases in listings on Airbnb, but time will tell. Okay, so top cities with the highest percent decrease in average rate compared to 12-week average. Okay, so Rosemary Beach down 49%, Hoboken down 31.8%, Indianapolis down 29.75%, Destin down 29.2%, and Sedona down 19.52%. Okay, so top cities with biggest increase in short-term rental listings June to July. So Fort Myers is up there at the top, went from about 811 to 900 properties. We'll keep watching that. That's 14% increase. And then Indianapolis at 6.5%, Las Vegas up 6.43%. This one is an interesting one. Very curious to see these movements, especially as we go through the winter. San Diego up at 6.24%, Oceanside at 5.32%. And then top cities with the biggest decrease in short-term rental listings weren't a lot of these. So these are interesting moves, and this is from June to July. So San Jose, 6.37% decrease. Phoenix down 5.25%. Portsmouth down 4.85%. San Ramon down 4.3%. And Tucson down 4.16%. Okay, top cities with biggest increase in short-term rental listings January to July. Okay, so Destin at 37%, Coeur d'Alene at 36.7%. Not surprised here. There's just so much inventory coming online, new build inventory in Coeur d'Alene, and then they're having a slowdown. Cape May at 31.9%, San Ramon at 28.9%, and Palm Springs 22.49%. Okay, and then top cities with the biggest decrease in short-term rental listings January through July. Okay, so this is from the beginning of the year. San Jose down 21%, Dallas down 18%, likely due to that new legislation. New York down 13.39%. Interesting side note there, Airbnb was suing New York City for its regulations there. That suit got kicked out this week. So we're about to see a lot more regulation coming in a lot of these cities. And then from January to July, there was a decrease in Fort Myers of 11.82%, and then Houston down at 8.5%. Okay, and then just very quickly, I'll go through this one quickly again. This top 10 definitely, well, sorry, one did change, but this is the amount of short-term listings, or the number of short-term listings in July. I just think this is interesting because these numbers are insane. So number one, New York, 26,809. Miami, 14,502. Las Vegas, 13,913. Houston, 11,588. Austin, 10,911. Atlanta, 10,879. San Diego, 10,746. Orlando, 9,763. And then Sevierville actually knocked out Nashville. Guys, if you've ever been to Sevierville, that they can knock out Nashville, that's just I don't even really have words for that. But Sevierville at 8,816 short-term rentals. Okay, so the other thing I did this week is finally I included also inside Airbnb data. Now you'll see that the inside Airbnb data is very different from the listings that I have, which are listings of Airbnb and VRBO. This all goes to methodology. I can't get into all of it right now, but hopefully by October, when I have enough inside Airbnb data and some of the other providers like AirDNA, Mash Advisor, All the Rooms, I'll be able to really do a deep dive into all of these different data sources and all of their issues. It's something I'm working on right now with one of my clients. And I can just tell you it's an ocean. So as much as I'd want to be able to have this conversation right now, I just can't. But I promise to have it soon so that we really can understand these different data sources. But they do tend to directionally go, they kind of go in the same direction. But, you know, one of the issues like with AirDNA, they do a 3-month average. They do a lot of modeling of their data, and it is a month delayed. So it's harder to see moves with their data. I think, you know, we're going to have to look at a whole bunch of different sources, and I'm actually trying to work on one that could, you know, be the best source because it would have sort of the best 360 view and come from a variety of different places and do scraping on a daily basis versus some of these are doing monthly. So, you know, take a look at that little schedule. It's interesting to see. They do have in-depth data. I'll just give you kind of, you know, a comparison. Like, you know, the data that I have shows about 10,000 plus in Austin, whereas inside Airbnb has about 14,000, over 14,000. Now, this could also be about the way that people define what Austin is. Is it the MSA? Is it a list of zip codes? Is it the city? Is it the metro? All of these things you have to look at when you're looking at data. And so it's super, super important when you're comparing things to understand they're not always being defined the same way. Okay, that was a lot of stats. Sorry about that. But as I get more and more data, you know, there's different ways to look at this. And I'm hoping to find someone who can help me with some graphs and charts as well. That's just not my strong suit. I'm a words girl. But, you know, just to give you better views and better understanding what's going on. But what I would say is, you know, this, again, is kind of the in-between time. It's been going for a long time because more and more these days, I think the sentiment swings based on what the stock market is doing, et cetera. It sort of, you know, really can change the movement of the market. And I absolutely believe that the financial media helped a lot with that in the spring and sort of pushing those new builds where you got a 10 to 20% net reduction in your price. So, you know, I think we're rounding to the corner to when I know that the builders have been enjoying a little respite from the beating they took last year and at the beginning of this year. But guys, if you saw these sites, you would know that it doesn't matter what their balance sheets look like. They're going to be, and this is not investment advice. I'm not telling anyone to invest based on what I'm seeing. I'm just letting you know that what I've seen on the road, it is very different from the narratives that we hear on their earnings calls. Okay, so thank you for joining. I really appreciate it. Please reach out to me with comments and questions. You can reach me on Twitter at m3_melody, LinkedIn, Melody Wright, Substack, the M3 Melody Substack, and then here on YouTube. Please leave a comment. I love to hear from you. And I get my best intelligence from you guys. I will be heading back over to kind of the Sarasota area, Tampa, etc. I'm either going to do that next weekend or on my way back up. Not exactly sure. But, you know, if there's a place or spots in Florida, please leave me a comment and I'll be very happy to go check them out. So thanks again for watching. I hope that everyone has a wonderful week and stay safe out there. Thanks, guys.